My name is Richard August, and I'll be your host. Our guest is Derek Amy, a partner and portfolio manager with Strategic Point Investment Advisors with offices in Providence and in East Greenwich. Welcome back to State of the State.
Hey, thanks for having me back.
And in full disclosure, I want to say that Mr. Amy is my financial advisor. You and co-host Laura Bard had a podcast recently on the topic of where did all the workers go? And everyone sees help wanted posters on businesses and signs all over the state. And owners of restaurants, nursing homes, and other types of service companies are complaining they can't find people to work. Truck drivers are in short supply, thereby contributing to supply chain woes. Hospitals are becoming critically understaffed. Incredibly, the Labor Department reported that 4.2 million people quit their jobs in October. This was down slightly from September, which was a record high of 4.5 million. At the same time, there are over 11 million jobs available. There's about 3 million more jobs than the 8 million people or so who are unemployed and available to work. In your podcast, you say 4.3 million workers are missing. What's going on?
Yeah, so just to be clear, they haven't disappeared off the face of the earth, but basically they're trying to figure out why aren't these people coming back to work? What's the primary cause? And as an investment manager, this does have some correlation with stock prices and bond prices, right? If this continues to be an issue, companies are going to have to pay more, and that can cut into profit margins. So we spent, Laura and I spent a good, half an hour and 40 minutes talking about some of the possibilities, because it's not going to be without the benefit of a real hindsight. Probably a year from now, we're going to exactly know, but some of the primary causes I think are actually kind of interesting.
In the podcast, you explain that gross domestic product, or GDP, is the total of all goods and services in the economy, but doesn't double count because it only applies to the value of finished products. I'm confused. Suppose I'm a farmer who raises corn. That's my finished product, but I sell my corn to Kellogg's, who processes it into cornflakes. They're a finished product. So are you saying the value of my corn crop is not included in GDP because it's processed into flakes?
So if you're selling corn at a farm stand, that is a finished product. If corn is being used in part of the process to create something else that makes that a finished product, then no, your corn is not a finished product. GDP is just a measure of trying to figure out how fast or how big is our economy here in the US, and you don't want to keep counting the same things. A microchip is always going to be put into some sort of finished product, so you don't count the manufacturing into GDP for that product. The final good, the cell phone, the computer, sure, but the actual process of creating that microchip, no.
So the assumption would be that my corn or Intel's...
It's not a finished product.
It's not and it's in the finished product, so its value must be there in the finished product.
Yeah, and so, economists and investors alike are always watching GDP, because that, by the way, whenever we go into a recession, what happens to GDP? That means GDP has gone down 2 quarters in a row, and that's the measurement that they use to say, hey, we're in a recession here.
Okay. Now, you talk about the labor force in the podcast. You talk about the labor force participation rate, which is reported on the first Friday of every month for the preceding month. And that statistic peaked in the year 2000 at 67%, which means 2/3 of the people who are available to work were working, but it's declined every year since. And in October, which is the latest data, it was 61.6%. Why do you think this is happening?
Right. So before I get to that answer, let's step back and think about why labor participation rate is such a big deal. If the economy in the U.S. is growing, and we use GDP as the measurement of that, what really drives GDP growth? Believe it or not, it's me, you, it's the guys behind the camera. 70% of U.S. economic growth comes from consumer spending. And another 2/3 of that, it comes from goods and services, right? Or actually services, sorry, I misspoke there. If the participation rate is going down. All things equal, that should mean less dollars in consumers' pockets, which means less dollars for us to go out and spend, and that's why people are paying attention to the participation rate. In respect to why did it peak in 2000 and why has it been going down, and it went down obviously aggressively following COVID and it continues to stay down, it's because of you and not because of me. The baby boomers. This is a demographic problem where the baby boomers are retiring at a faster rate than the people coming back into the workforce and working. They measure the labor participation rate up until age 64, so once you reach over that, you're no longer considered part of the workforce. But we've seen this slow, steady decline. Then COVID hits. It drops precipitously, and everyone expected it to spike when it came back. And speaking to your point of we have all these open jobs, everyone's assuming all those jobs would be filled and everything would go back to normal, and it hasn't happened. And if you want to get into some of the reasons why that might be, one of the biggest challenges is daycare. Right now, daycares are having a harder time finding people. It's not the most glamorous job, doesn't typically pay very well, and tends to be done by, females, not to be stereotypical, but tends to be working moms themselves that are in that space. And now so the cost of daycare is going up, and a lot of families are starting to make a decision, where's the break-even point? You know, do I send you to work if I'm going to have to shell out someone to watch my kid for 8 hours a day, and the cost of watching that child for 8 hours a day has gone up because they can't find people? Kind of feeds on itself. The other thing is people are being affected with COVID, and there's some jobs, obviously, in the services industry where people are a little hesitant because it's a high-risk job. Maybe not, they're not on the front lines from a cop or a fireman, but if you're in a restaurant dealing with a bunch of strangers, we have no idea what their vaccination status is or whether or not they take this seriously or not, and you have some of your own underlying health issues, maybe not the primary job that you want to jump into. I'll pause there to let you chime in.
I want to clear the record, though. I'm not a baby boomer. I was born on the eve of World War II. Okay. So the baby boomers are from 46 to 66. So just want to clarify that. But so do we have a labor shortage or shortage of workers?
Yeah, so that was one of the questions that we talked about on the podcast, and I think it's probably going to end up being a combination of those two. Some of these jobs have been low-paying wages for a long period of time, and they're struggling to find people to come out of work, and there's other reasons why they haven't gone back to work. Another example, hotel workers. Corporate travel is down, so hotels are doing more with less. And when they're going to find, or they're trying to find those people, unfortunately, some of those people have probably gone on to different careers if they've needed to. I mean, our country has seen this kind of labor shortage before, but it was always segmented to certain industries. So think about 2008, right? 2008 was a great financial crisis. It was really centered, laser focused on the real estate. If you were in home construction or building construction back then, you probably didn't survive if you weren't at one of these major companies, and then those people had to go find other ways to provide for their families. What we're living through now is every industry is being affected this. Bus drivers, I don't know if you've seen any of these stories, but the bus drivers, they're struggling. We have a major shortage of that. Well, it tends to be a job that people work. I think the average age of bus drivers I heard was like 55, 56. Getting on a bus with a bunch of 50 or 60 kids who aren't vaccinated, again, some concern. The problem is you also need a CDL license. Well, I happened to notice a package was being delivered as I was leaving the office today by a gentleman who was driving a truck for Amazon, and he needs a CDL license. Who's going to compete in that sort of environment? You think a school bus driver salary is going to compete with his Amazon salary? Probably not.
Yeah. So I guess when you talk about this decision of working women, working moms, it really comes down to, it seems to me that you talked about the break even. I mean, you have to sit down and you say, well, I have the cost of transportation, clothing, food because I'm at the office and not at home. And then I look at the cost of daycare or pre-K,
yeah,
and I say, well, after I get all said and done and I work my 40 hours or 35 or whatever, it's not even worth it me going to work. I might as well be a stay-at-home mom. Is that
that's part of it. The other problem is, we have a gentleman who works in the office. It's December when we're taping this. His son has had to miss 3 weeks of school already because he's in close contact. Now, luckily at my employer, we have flexibility where people can work from home. But if you're a mom who's trying to juggle career and you've already missed 3 weeks of school and it's only 4 months into the school year, you're starting to figure, is this really worth it? So we know a large portion of those people have left. The other thing is, a large portion of people have decided, I think, to retire. Again, this is a new phenomenon. Previous in recessions, what happens to the stock market? I know, stock market goes down. Let's go back to 2008. Your home value went down, your stock portfolio went down, so no one was going to retire. Home values are up, stock market's doing really well, and I think your generation, not your generation, but there's a fair amount of baby boomers who are just saying, I got enough. I don't need to spend as much as I have. Look how great, the rest of my net worth is doing. And they're just saying, this is it. And, calling it a career.
Yeah, or maybe I can just get a little part-time gig somewhere, maybe being paid under the table from cash money. It'll supplement my retirement out of my 401k or IRA.
Yeah, I do think there's probably a fair amount of people who are doing things surreptitiously. This is a safe space, so I don't know any of them personally. Please do not call me. But all kidding aside, obviously, as you know, the IRS is aware there's a fair amount of people who do this. That's why they're trying to come up with this $600 transaction at the bank, because they're trying to find a way to keep an eye on for the companies that are dealing with all cash businesses.
Well, I think this is also a point for me when we look at President Biden's, what he's calling his Build Back Better spending proposal. He really emphasizes government subsidized daycare and universal pre-care. I guess this is to get working women back into the workforce.
I believe that's obviously the intent. As someone who's writing that check every month, because I have kids 4 and 2, I can attest to how costly it is. At the same time, whether or not we can all afford to pay for that price as taxpayers remains to be seen.
In your podcast, you said more workers equals more discretionary spending, which will increase GDP. Now, however, you also said that we do not have a demand problem, we have a supply problem. And I seem to recall from Economics 101 a long time ago that when demand increases and supply is about the same, there are only 2 outcomes: increasing prices, which is inflation, or shortages, or a combination of both. You say what?
I would agree with that. If you think about the previous 6 or 7 recessions here in the U.S., what happens? Usually you have a demand shock, meaning people stop spending, you stop buying cars, stop buying houses, you stop taking vacations. And psychologically, that has a really negative feedback loop where all of us start to get concerned, and people do lose their jobs. That's a normal recession. So COVID hits, the government opens the book. What do we do when there's a recession? Okay, we lower interest rates, because normally that spurs demand, right? If you go back to 2008, the home values were going down. A way to put a floor in home values, you drive interest rates down as low as you can so people can go out and get a mortgage and buy a bigger house, because now the mortgage costs less. Okay, so they opened the book when COVID hit. Okay, knee-jerk reaction, low interest rates. The problem is, this is the first time in modern history. This is not a demand problem. We have a supply shock problem. So the book of how to fix previous recessions needs to be thrown out, and they need to kind of come up with a new system here. But we're far too into the recovery for that to help us now. Getting back to the labor participation rate and why we're talking about where do these workers go, if the workers don't come back, industries are going to struggle with the supply part of the equation, and we're all going to be dealing with some inflation.
Well, I think the supply situation, of course, goes back to what we see happening on the West Coast with freighters sitting at anchor for weeks, not able to unload. President Biden said, I'm going to fix this, but I'm going to tell them to open 24/7. And when a couple of the ports opened 24/7, there was no CDL drivers. To your point about, CDL drivers, long distance drivers come in and they say, I didn't want to do this. I didn't do it during COVID. I'm going to find something else to do. I'll drive an Amazon Prime delivery vehicle, right? So
I think, if you ever gone to a carnival, there's that whack-a-mole game where the mole pops up and you're supposed to whack the thing back down. Our economy has that sort of issue. Well, we'll just keep the ports open 24/7. So you whack that mole down, and someone goes, "Yeah, but what about all the trains? Because those guys are union, and they didn't sign up for this, and we have to go renegotiate if they're going." All right, so whack that mole down. Okay, so now you got the trains running, but they got to get offloaded somewhere else, and then you go chase this stuff down. I mean, in some ways, I think it is a testament to just how smoothly stuff were running pre-COVID. Mm-hmm. I mean, amazing how how much society had progressed to just-in-time manufacturing. The fact that you can order something on Amazon and it's at your house 24 hours later. I mean, amazing. But now that there's been this shock, and COVID was that shock, it's just showing you how fragile the entire economic system is. And I think we could be dealing with some of these reverberations for years.
I was talking to a gentleman who runs a furniture store, and he said that in December, prior to December of last year, he paid $2,000 for the container from furniture that he was importing from, I think it was Indonesia.
Yep.
Last December, a year ago, he was told by his export company or import, I guess, that the cost would go to $4,000. He has been notified this year the cost will be $22,000 per container. He said the value of the goods inside is about $54,000. So just the cost of the container, not transporting that container on a truck when it gets to port,
right,
is phenomenal. And that's only one thing that it can result in is what we call, I guess, a cost pull inflation. He can't absorb that.
Yeah, and first, again, going out to the 30,000 foot level, it's possible that we've started this trend towards deglobalization, where if these costs and the economics of shipping something from Far East Asia to the West Coast, to put it on a train, to ship it out onto the East Coast, to then get unboxed, put together, and to deliver it to someone's house, the economics may start to actually swing back, where we start to see manufacturing jobs return to the U.S. because of the fact that it's not as cheap as it used to be. Mm-hmm. China the average worker in China, I think, is on a 12-year run of a pay raise. Clearly, we're not seeing that here. They're trying to boost their consumer economy. They actually want to be more like us and less reliant on exports and more reliant on consumers. One way to do that is to boost their salaries of their workers in their country. The process of doing that reduces the economic advantage that they've had for years and years and years. Again, and Dick and I have had arguments about inflation and the secular trends, but again, that would be a secular trend which would actually increase potential inflation going forward, because you're not manufacturing goods on the backs of cheap labor anymore.
You noted that you and your colleagues are hearing Gen Xers say they never plan on retiring. Wouldn't this help solve the shortage of workers if they didn't retire? What do you tell them?
Yeah, so I got up on a little bit of a soapbox on the podcast because I'm disappointed whenever I meet someone in my age group. I am a Gen X, and a lot of us have this defeatist attitude. I'm never going to be able to retire. I'm never going to be able to retire, so they don't bother to address it. And what I was taking the 5 minutes during the podcast to say is, wake up. The reality is we're all going to retire at some point. The question is whether or not it's under your choice or something else. And what's that something else most of the time? Health is the number one reason that people retire before they're ready. And if you're going through life thinking you're never going to retire, then you also go through life saying, I don't need to save and prepare for it. That's a mistake. We are, God willing, we're all going to get to the point where we're going to retire, and you can't keep ignoring it. And for Gen X, we're still young enough. We still have 20, 30, 15, 20 good years of working and good salaries. Now's the time. There's still time where you can fix it.
Companies are offering signing bonuses for many openings, in addition to raising the starting wages for unskilled and inexperienced workers. Is this going to mean we'll see wage push inflation on top of this?
Yeah, I think you already are starting to see some of that. The lower wage earner salaries are actually growing at a faster rate than the white collar jobs. You know, power is returning back to labor after it's been so heavily on the backs of capital for such a long period of time. I think as a society, that's not the worst thing in the world, as long as it's not, you know, a rapid sort of increase. But companies are being forced to be creative to find good work. You spoke earlier about we have more open jobs and we have people looking for those jobs. There's certainly a job mismatch on people's talents, and schooling will fix some of that, but it takes a while. You know, these kind of things don't happen overnight, and they also don't get fixed overnight.
The last time you were here, we discussed modern monetary theory and its effect on inflation. Now, syndicated columnist Victor Davis Hanson wrote in the Providence Journal on December 12th, and I quote, "Modern monetary theorists assured us that printing money would spread the wealth around and devalue the cash of undeserving capitalists who had too much of it. Printing more cash, they believed, would implant it in the hands of the needy who unfairly had too little. To the extent inflation followed, it would be a good thing, they hoped, a sign of a newly empowered and robust consumer class long denied equity," end quote. You say what in response to that?
Well, I think it's a little premature to say whether or not modern monetary theory is, you know, a bad policy or a good policy, to be perfectly honest. A lot of the inflation is happening because of the fact that we just don't have enough people working, and there's that supply issue. I get where he's coming from. As easy as it is to criticize MMTers for taking a victory lap, it's also easy to criticize those who are throwing stones. I think it needs to kind of play out a little bit. I mean, we are starting to see gas prices fall or come down, maybe not so much at the gas pumps, but the day after Thanksgiving, barrel oil was down $10. We are seeing lumber prices come down. I mean, the economy is somewhat healing. It's just not healing fast enough for some of our taste and for some of our spending habits. But I know what he's saying, and I know where the criticisms lie. I didn't come on here last time saying I was convinced MMT was the way to go myself, but I think it's a little premature to basically criticize it because of, you know, 18 months of inflation.
So what is the Labor Department has reported that inflation is 6.8%, which is extremely high, and not historically perhaps, but in the near history. But I was around during the Carter years when it was 18%. And 6.8% inflation, if wages are increasing 3%, is sort of a hidden tax on working families, working people. So what is causing that inflation?
Well, again, it's because there's not enough supply and there's a lot of demand. And look, the Fed could fix this, but unfortunately, the price to pay for fixing this right now is too high. Right? What could they do? So the Federal Reserve treats interest rates kind of like your brake pedal when you're on the highway. They're not going to jam on the brakes, but they can take some of the speed off of the growing economy. But in exchange for that, stock market's not going to like that. Housing market's not going to like that. You and I aren't going to like it, and a lot of investors and voters coming into a midterm election next year aren't going to like that. So you get in this sort of balancing act where it's like, well, how do we rub some of the speed off, take some of the sting out of inflation, but in a way that doesn't spook equity markets and bond prices and everything else. Because if you had a major market correction, you could actually have a self-fulfilling recession because people will all say, oh God, my 401k is down, I'm not going to take this vacation, blah, blah, blah. It's a complex system. There are solutions, but it's that whack-a-mole thing. You want to fix inflation? Okay, now you got a stock market correction that you have to deal with, et cetera, et cetera.
So it sounds like the Fed and they're kicking the can down the road because it's an election year. They don't want to take the bitter pill, but eventually we're going to have to. And
Well,
the Fed,
they planted their flag in transitory, and then in the last 3 weeks, they've sort of came out and said, well, that was a mistake. I think they were trying to hope that it was going to be transitory, and basically probably not really willing to publicly admit that they kind of probably knew that it wasn't going to be transitory. And now that they've sort of admitted it, they're talking about potentially, increasing the pace at which they slow some of their economic help and support.
the amount of savings that many people didn't spend these stimulus checks, their personal savings, is pretty high. If the Fed increases interest rates on the plus side, that would mean interest rates on money markets and savings accounts would presumably go up, because right now it's ridiculous. They're basically zero.
Yeah, so you know how they talk about gas prices tend to be downward sticky. They're quick to go up, and then it takes a long time for oil prices to be below where they were originally for the gas prices pumped to come down. You probably won't like this, and retirees won't like this, but money market tend to be upward sticky, where they're going to keep staying down there for as long as they can until they start to see the money flow out into other places. But yeah, to your point, there's a ton of, there's our studies where we're seeing that the tremendous amount of Americans are sitting on a tremendous amount of cash. As a stock and as an investor, that is attractive. That's money, because again, how does our economy grow? It grows from consumer spending. That means there's a bunch of kindling there that could fuel spending in the future. You got to motivate those people to get off of it. And if I could actually just add one more thing, don't underestimate that that isn't the Federal Reserve's goal of keeping interest rates low. They see all that cash. They want you to do something other than just park it in a bank account. It may be the smartest thing for you and your family to sit on that cash, but they want you to go spend it. They want you to invest it. They want you to give it away to somebody who's going to spend it. You know, they don't come out and say that, but that's certainly one of their intended consequences.
We have a few minutes left, and I'm just wondering what, in light of this report on inflation, what policies or what, as a portfolio manager, what are you looking at to defend against rising inflation?
Yeah, it's hard. You know, you're traditionally, you asked me this last time, you get pushed into some of the more alternative assets than just stocks and bonds. You know, buying shares of Exxon is not the same as buying actual energy contracts. For the average retail investor, it's not easy to own commodities for a myriad of reasons that are beyond the scope of today's TV appearance. But, you know, if you buy companies stock that happen to participate in that commodity space, it's not always a one-for-one correlation. People look towards gold, people look towards Bitcoin, people are looking for these other things. I think part of the reason that Bitcoin's even as high as it is because it's showing you that there's a thirst for many Americans to look for some way to shield their own net worth against inflation. But yeah, it's been hard for us and for many people to find those positions that will counterweight inflation.
This is sort of a political, economic question combined. The president wants to spend, who knows, he says $3.5 trillion. The Congressional Budget Office says it's way more than that. But we're theoretically coming out of this recession, out of the COVID recession, let's call it. Do you think we need to spend trillions of dollars on a package to bring us out further? What effect is that going to have?
Well, you probably could have started tonight's show with that question to give me
the whole half hour.
To give me 30 minutes to answer it. Look, I mean, you know, we're in a democratic society, and these are the people we've voted in, and they're the ones making the decisions at this point. Obviously, I think you know me well enough to know there's a fair amount of criticism for some of the policies, and on the other hand, there are some other policies that I probably would support, and they may not align with how you look. At the end of the day, my clients pay me to say, what is this going to do for stock and bond prices, not what my political lineage is. So, you know, obviously, if the federal government is increasing spending in certain areas, that is going to benefit certain industries, and you want to make sure that you have an asset allocation towards those.
Well, I think we are almost ready to wind up, and I want to thank you for coming back again. And as we get into the next year, and we see what these policies are taking, how they take effect, perhaps you'll come back and join us once again.
I'm always happy to come on.
Thank you very much.
Thanks.
And thank you, audience, for watching State of the State. And we want to wish all of you a Merry Christmas and a Happy Hanukkah for our Jewish friends. And please stay with us for 2022. Thank you.